Congratulations. Application has been approved. $50,000. No credit check. What's going on, YouTube? Welcome to the Credit Plug channel. If you haven't already, make sure you hit that like button as well as smash the subscribe button. Also, as a reminder to all viewers and subscribers, this is not financial advice. This is for informational purposes only. Now, in today's video, I'm going to be showing you an example of why all money is not good money. Now, just because you get approved for a loan doesn't mean you should necessarily take it. Now, the way the credit system works is that the better the credit reputation that you have, the more favorable loan terms that you're going to be able to get. So lower interest rates as well as higher limits. Now, there are certain lenders that have a specific business model in terms of the types of customers that they want to target. So the best financial products are actually going to be coming from the larger financial institutions, because larger financial institutions like Chase, Bank of America, American Express, those types of financial institutions are going to be more catered to prime credit customers. Now, when you don't have the best financial reputation, that's where some of these alternative lenders come in. You have some of the fintech organizations. Now, I'm not knocking the fintech organizations, but when we're looking at favorable terms in terms of interest rates, the big banks are obviously going to have a better advantage when you're looking at the loan terms. All right, so this loan was from Fintech Lender Funding Circle. Now, just to clarify, I didn't actually accept this loan offer. I just went through the process of applying, submitting documentation, and just to see what terms were going to be provided, right? And so I just wanted to share this with you. So for some of you who aren't familiar, Funding Circle is a fintech lender. Now, pretty much how they work, so they administer SBA 7A as well as 504 loans, but they also have a Funding Circle Marketplace. So that's what this stands for, FC Marketplace LLC. Now, basically what they do is they're sort of like an intermediary where they have investors who fund these different loans. So when you apply for a loan, they basically present your information to an investor. An investor will look at your different data points and decide whether or not they want to fund your loan. So that's pretty much how they work. So they're kind of like a middleman between the investor and the borrower. So I decided to apply for a $50,000 loan. And as you can see right here, 16.25% APR. And so obviously I didn't accept the loan. You know, this was just for informational purposes. I just wanted to get a feel of what the process was like, what the data points were required to get approved, as well as, you know, what types of terms that they would actually give you. So 16.25% is obviously a very high interest rate, in my opinion, especially given my data points. And so I just wanted to share this with you just to let you guys know that all money is not good money, right? 16.25% APR. So this was a $50,000 loan over 60 months, and the monthly payment would be $1,295.79. And as you can see down here, total repayment, right? So this includes scheduled payments of principal and interest that you will pay over the life of the loan, $77,747.40. Now, like I said, obviously, I don't need the loan. This is just for informational purposes, but I did just want to show you guys this illustration. Now, another thing I wanted to point out, when you see the loan amount right here, $52,995, right? So there is 5.99% origination fee that they package into the loan. So they'll put this on top of the original loan amount. So they basically just took 5.99% of 50,000 and then tack that on to the original $50,000 loan amount. So 5.99% of 50,000 is about, you know, $2,995. So they basically, you know, package that into the loan. So the actual loan amount is going to be $52,995. The disbursement amount is going to be $50,000. So that's the actual proceeds. Now, one of the things you should really keep in mind when you're taking out any type of loan is looking at the amortization schedule. So the amortization schedule breaks out all of the payments of an installment loan, and it gives you the due dates for each payment, as well as the amount of the payment, and then the principal, as well as the interest. So one thing you got to keep in mind, so as you can see right here, and this works the same, I would say, with like mortgages, right? Usually a lot of the interest is going to be on the front end of the loan. So as you can see right here, you know, the payments are $1,295.79. But when you look at how much is being applied to principal and how much is being applied to interest, so paying down principal lowers the loan balance, but the interest does not get get applied to the loan balance. So that's one thing you have to keep in mind. And a lot of times, lenders don't even give you the amortization schedule, right? And so you might not understand how the interest and the principal are being applied. But as you can see, the interest is much greater than the principal very early on in the loan. It's not until later down, that the principal actually starts to be greater than the interest on the loans. It all depends on how you plan to deploy the capital to really get a sense of if taking out the loan with these terms actually makes sense for your business needs. So I actually have lines of credit at half the APR that they're charging on this installment loan. So in my case, this would never make sense to, try to take out, the loan at those terms. Now, and again, depends on how you're deploying the capital, what type of return you can see from taking that money and deploying it. It all depends on your business. Now, if I really needed a loan for $50,000, me personally, I wouldn't go to one of these, third-party fintech marketplaces. I would just go to my primary bank where I already have a relationship and, I can get way better terms. But again, not everyone is going to be able to go to the large banks because they're going to require a lot more documentation. And the process sometimes takes a little bit longer to close on. So you're going to need higher credit, tax returns, financials, and stuff like that. Now, one advantage I will say with some of these fintech lenders is the speed of funding. So I was actually able to get an offer, I would say, within about 2 business days of submitting all the necessary information. So there are some trade-offs, but if you have a good financial reputation, good credit, good financials, tax returns, bank statements, stuff like that, you don't necessarily need to go to, certain types of lenders. So anyways, that's all I wanted to cover in today's video. Let me know your comments and questions down below. And until next time, take it easy and we'll talk to you soon. Peace.